Imagine the United States in the early 1880s. On the surface, it's a time of great optimism. The Civil War is a fading memory, and the nation is racing into the Gilded Age, a period of rapid industrialization and economic growth. The air is thick with the promise of prosperity. Cities are expanding, factories are churning out goods, and the iconic symbol of American progress, the railroad, is crisscrossing the continent, stitching the nation together with iron and steam. Everyone, it seems, is getting rich, or at least they know someone who is. But beneath this shimmering veneer of success, a different story is unfolding. The foundation of this prosperity is more fragile than it appears. The economic engine is being fueled by something far more volatile than coal: rampant speculation. The railroad industry, in particular, has become a massive casino. Investors, both large and small, are pouring money into new railway lines, often with little regard for whether these lines are actually needed or will ever be profitable. It's a gold rush on wheels, with fortunes being made overnight on paper. The mantra is simple: buy, buy, buy. Railroad stocks are soaring to dizzying heights, disconnected from their actual value. It's not just railroads. A similar frenzy is happening with Western land. The government is practically giving it away, and speculators are snapping up vast tracts, betting that the relentless tide of settlement will make them rich. This speculation creates a massive credit bubble. Banks are lending money freely, often using the very same speculative railroad stocks and land deeds as collateral. It's a house of cards, built on borrowed money and boundless optimism. Everyone believes the party will never end. But, like all bubbles, this one is destined to pop. The only question is, what will be the pin? The stage is set for a dramatic financial reckoning that will shake the heart of American capitalism. The year is 1884, New York City, the financial capital of the world. Wall Street is humming with its usual chaotic energy. But on May 6th, a tremor runs through the financial district. A prominent firm, the Marine National Bank of New York, suddenly collapses. The news hits the street like a thunderclap. This isn't just any bank. It's closely tied to a high-flying brokerage firm called Grant & Ward. And who is the Grant in Grant & Ward? None other than Ulysses S. Grant Jr., the son of the former president and Civil War hero, Ulysses S. Grant himself. The firm had been marketed as a surefire investment, trading on the impeccable reputation of the Grant name. The silent partner, Ferdinand Ward, was known on Wall Street as the young Napoleon of finance. He promised investors incredible returns, sometimes as high as 10 to 20% per month. It sounded too good to be true, and it was. Ward was running a sophisticated Ponzi scheme. He was using money from new investors to pay off earlier ones, all while living a life of extravagant luxury. He claimed to have lucrative government contracts, secured through his association with General Grant. But it was all a lie. The firm was a hollow shell, propped up by fraud. When the Marine National Bank, which had been deeply entangled in Ward's schemes, went under, the entire house of cards came crashing down. The failure exposed Grant & Ward for the fraud it was. The revelation was a bombshell. Not only had hundreds of investors been wiped out, but the personal fortune of Ulysses S. Grant, who had invested his life savings and even borrowed against his name, was gone. The hero of the Union, the man who had led the nation through its darkest hour, was left financially ruined. The scandal sent a shockwave of distrust through the financial community. If a firm with the name Grant attached to it could be a complete fraud, who could you trust? The spark had been lit, and the kindling of Wall Street was about to erupt in flames. The collapse of Grant & Ward was just the beginning. The news spread like wildfire through the telegraph wires and gossip mills of Wall Street. Fear, a far more powerful force than greed, began to take hold. If a firm connected to a former president could be rotten to the core, what other skeletons were hiding in the closets of New York's banks? The public's confidence, the very bedrock of the banking system, was evaporating. And that fear quickly found a new target. The Metropolitan National Bank. Whispers and rumors started to fly. The Metropolitan was said to have heavy dealings with the same kind of shady railroad securities that had plagued other failed institutions. In the 19th century, there was no FDIC, no government insurance to protect your savings. If a bank failed, your money was gone. Period. The only rational thing for a depositor to do at the first hint of trouble was to get their money out. And so, the panic began. Lines of anxious depositors started forming outside the doors of the Metropolitan National Bank. These weren't just a few worried people. It was a full-blown bank run. Men in top hats and women in bustled dresses, people from all walks of life, crowded the streets, their faces etched with anxiety. They were all there for one reason: to withdraw their cash before the bank's vaults ran dry. The scene was one of controlled chaos. Police were called in to manage the crowds, but they could do little to quell the rising tide of panic. Inside the bank, tellers worked frantically, counting out piles of cash, their faces grim. The bank's reserves were draining away at an alarming rate. The sound of the mob outside grew louder, their demands more insistent. The fear was contagious. The failure of one bank could trigger a domino effect, bringing down others in a chain reaction. This was the nightmare scenario for Wall Street, a complete meltdown of the banking system. The panic was no longer just about one or two fraudulent firms. It was threatening to consume the entire financial heart of the nation. The pressure was building, and it seemed like the whole system was about to implode. As the panic on Wall Street reached a fever pitch, with depositors clamoring for their cash and banks teetering on the brink of collapse, a group of the city's most powerful men gathered for an emergency meeting. This was the New York Clearinghouse Association, a consortium of the city's major banks. In an era before a central bank like the Federal Reserve existed, this private institution was the only line of defense against total financial chaos. They knew that if the Metropolitan National Bank failed, the panic would spread uncontrollably, potentially taking down dozens of other institutions with it. They had to act, and they had to act fast. Their solution was a clever, if unorthodox, financial innovation: loan certificates. Instead of transferring huge sums of physical gold or cash between banks to settle accounts, which would have further drained their reserves, the clearinghouse decided to issue these certificates. Essentially, they were a form of temporary, emergency currency backed by the collective assets of all the member banks. A bank that was facing a run, like the Metropolitan, could use these certificates to settle its debts with other banks, allowing it to preserve its precious cash to pay its depositors. It was a bold move, a way for the banks to collectively guarantee each other's solvency and project an image of unity and strength to the public. The plan worked. The issuance of over $24 million in loan certificates acted like a financial firebreak. It reassured the market that the banking system as a whole was sound and had the resources to withstand the shock. The visible cooperation among the city's top bankers helped to calm the frayed nerves of the public. The run on the Metropolitan slowed and then stopped. The immediate crisis was contained. The panic, which had threatened to engulf the entire country, was largely confined to New York City. However, the story doesn't end there. The Panic of 1884 wasn't just a dramatic, week-long event. It was a symptom of a much larger economic illness. It marked a particularly sharp downturn within a longer, more grinding period of economic hardship known as the Depression of 1882 to 1885. While the clearinghouse had managed to prevent a total systemic collapse, they couldn't erase the underlying problems of overspeculation and fragile credit. The panic served as a harsh lesson, exposing the inherent instabilities of the Gilded Age economy and the desperate need for a more robust financial regulatory system. It was a stark reminder that in the world of high finance, the line between boom and bust, between prosperity and panic, can be terrifyingly thin. Thanks for watching, and if you enjoyed this look into financial history, don't forget to like and subscribe for more.